In early 2026, gold was nearly touching $5,600 an ounce, and then, in a single week, it plunged over 10%, with a further 7.8% drop on a single Monday. For those who poured money into gold as the ultimate safe haven, believing it would shield them from the ongoing war in Iran and market volatility, this crash was a brutal wake-up call. Everyone says gold is the answer when things get tough, but 2026 just proved that's not always true. What actually caused this historic collapse, and what does it reveal about the hidden costs of relying on gold when you need it most? Stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. In early 2026, gold prices soared, nearly touching $5,600 an ounce globally, driven by fears surrounding the ongoing war in Iran. Yet, just weeks later, traditional safe haven investors watched in shock as gold plummeted a staggering 7.8% in a single Monday, following a 10% decline the previous week. This wasn't just a dip, it was a dramatic re-evaluation of gold's role as the ultimate safe haven, especially when you consider that since the Iran conflict began, gold has actually started to fall when risk aversion spikes. Morgan Stanley Research even questioned, is gold still a safe haven, on May 5, 2026, as prices dropped instead of rising. What this means for someone in your situation is that relying on old assumptions about safe haven assets can expose you to unexpected risks. We're going to dig into why this happened, the hidden costs gold investors often overlook, and what the data tells us about gold's true performance during market turmoil. Can you believe that just weeks before its dramatic fall, major financial players were still championing gold as the ultimate safe haven? In early 2026, gold truly became the golden illusion for countless investors. It soared, nearly touching that record $5,600 per ounce globally, largely fueled by the intensifying war in Iran. The prevailing wisdom was simple. Geopolitical instability meant gold would only go higher, a trend we've seen historically. Even on February 27, 2026, VanEck, a well-respected investment firm, published a positive outlook for gold, reinforcing this exact safe haven narrative. Investors poured in, convinced they were insulating their portfolios from inflation and the predicted energy price shocks tied to the conflict. They genuinely believed this was their shield. But as Mark Malek reported on March 26, 2026, gold actually peaked before the real geopolitical escalation with Iran. This directly contradicted the long-held belief that it rises during crises. During the actual period of heightened risk, gold declined sharply. Imagine being an investor, watching gold plummet 10% in a week, then another 7.8% on a single Monday, just as the headlines screamed about escalating conflict. Morgan Stanley Research even published Is Gold Still a Safe Haven? On May 5, 2026, casting serious doubt on its traditional role. The lesson here is that market narratives, even those deeply ingrained, can break down spectacularly when reality doesn't align. But if it wasn't the war in Iran driving gold down, what really sent it tumbling? But here's the kicker. The very conflict everyone thought would send gold to the moon actually triggered its spectacular crash. You see, the intensifying war in Iran, which started with US and Israeli bombing on February 28, 2026, was initially seen as a clear bullish signal for gold. Traditional market logic dictated that geopolitical instability, rising inflation fears, and soaring energy prices should have pushed gold prices dramatically higher, reinforcing its role as a crisis hedge. Yet, as Mark Malek of Seabird blog noted on March 26, 2026, gold actually peaked before the significant geopolitical escalation. Then, contrary to every expectation, it declined sharply during the actual period of heightened risk. Morgan Stanley Research confirmed this on May 5, 2026, stating that gold prices had dropped since the start of the Iran conflict, directly challenging its safe haven image. Robin J. Brooks observed on June 5, 2026, a fundamental shift. Gold began trading like a high-beta asset, falling when risk aversion spiked. This counterintuitive reaction had investors frantically re-evaluating their portfolios. Gold's price tumbled over 10% following the February 28 bombings, and then that staggering 7.8% drop on a single Monday. For example, the euro depreciated about 7% against the dollar, making gold effectively 7% more expensive for European investors, reducing demand significantly. But here's the truly brutal reality. Gold, the supposed safe haven, not only failed to protect investors, it significantly underperformed other major assets when it was needed most. Let's look at the numbers because they tell a very clear story. In early 2026, many thought gold would be a shield, but it became a wrecking ball for portfolios. As detailed by sources like TradingKey and 5paisa, gold's performance throughout 2026 was marked by a notable decline and diving price movement. Imagine waking up one Monday to see your gold holdings down a staggering 7.8% in just the early hours of the trading day. And that wasn't an isolated incident, it followed a painful 10% decline in the previous week alone. This significant plunge in both gold and silver was even highlighted by Motilal Oswal, MOFSL, in an article on April 27, 2026. Think about someone who poured, say, $100,000 into gold at its $5,600 peak, expecting it to soar with the Iran conflict. Within 2 weeks, that $100,000 would have shrunk to roughly $82,000, representing a loss of $18,000. This wasn't just a paper loss, this was real capital evaporating at a time when people expected protection. As Mark Malek critiqued on March 26, 2026, the safe haven myth was truly challenged. Gold fell hard during the very crisis it was supposed to mitigate and, crucially, underperformed other major assets. This performance led Morgan Stanley Research to publish "Is Gold Still a Safe Haven?" on May 5, 2026, clearly signaling that institutional doubts were emerging. The lesson here is profound. Historical narratives about safe havens can be inverted in real time. But what does this mean when gold starts acting like a growth stock, reacting to entirely different market forces? Here's the real shocker. Gold, the supposed protector, actually started behaving like a high-risk gamble. Robin J. Brooks, a leading economist, published a groundbreaking observation on June 5, 2026, unequivocally stating, "Gold has lost its safe haven status." This wasn't just a minor shift. Brooks asserted that gold was now trading like a high-beta asset. Essentially, it was behaving like a riskier, more volatile investment. This completely inverted its traditional role. Think about it. The long-held belief was that gold would rally when geopolitical tensions were high and markets were uncertain. But as Brooks explained, gold was now falling when risk aversion spikes and only rallying whenever there's rumors of a peace deal. Let's put that into perspective. Historically, when a conflict like the intensifying war in Iran, which saw US and Israeli bombings starting February 28, 2026, escalated, gold prices would surge as investors rushed for safety. But in 2026, we saw the exact opposite. Morgan Stanley Research, in their May 5, 2026 report, "Is Gold Still a Safe Haven?" confirmed that gold prices had dropped since the start of the Iran conflict. This means for someone holding gold expecting protection, they were actually watching their asset decline during the very crisis it was supposed to shield them from. Ben McGregor echoed this on June 11, 2026, noting that gold was increasingly exhibited selling pressure during market stress and liquidity crunches. The lesson here is that past performance, even for an asset with thousands of years of history, doesn't guarantee future behavior, especially in rapidly evolving global markets. The ultimate betrayal. Peaking before the storm? But what if the entire premise was wrong, and gold peaked before the storm even started? This is the ultimate betrayal for safe haven investors. Mark Malek, reporting on March 26, 2026, delivered the shocking revelation. Gold actually reached its peak before the geopolitical escalation with Iran truly began. This directly contradicted the traditional narrative that gold shines during crises. Instead, it suggested a preemptive, unsustainable bubble where spot gold surged past $5,000 an ounce, even briefly touching $5,071, then nearly $5,600 globally in early 2026, fueled by expectations that never materialized. The implication here is profound. Investors who bought gold as a safe haven after the Iran conflict intensified, thinking they were buying protection, were hit the hardest. For example, if someone bought gold on March 3, 2026, when prices surged dramatically following initial US-Israel strikes on Iran, they would have seen their fortress crumble when they needed it most. By March 16, gold had already dipped below $5,000, trading around $4,985. This wasn't just a minor blip, gold experienced a staggering 7.8% drop in one Monday's early hours, following a 10% decline the previous week. Morgan Stanley Research, on May 5, 2026, reinforced this, publishing "Is Gold Still a Safe Haven?" revealing that prices had consistently dropped since the start of the Iran conflict. By July 23, 2026, major financial institutions had significantly lowered their gold price forecasts, cementing its new, uncertain status and leaving those safe haven investors burned. The lesson here is clear. Sometimes, the market prices in an event so aggressively that the actual event becomes the catalyst for a reversal, not a further surge. So, the lesson here is that 2026 wasn't just another year for gold, it was a fundamental redefinition. The old playbooks, the idea that gold automatically acts as a shield during geopolitical storms and inflation fears, those were utterly shattered. We saw gold, the supposed protector, actually behaving like a high-beta, high-risk asset, even peaking before the worst of the Iran conflict. This isn't just a market blip, it's a seismic shift that demands a complete reassessment of gold's role in a balanced portfolio, especially for anyone who believed in its safe haven status. Tell me, after seeing these numbers, has your perspective on gold changed? Have you ever had an asset you thought was safe completely betray you when you needed it most? Share your stories in the comments below. And if you want to keep unraveling these outdated financial assumptions with real data, make sure to hit that subscribe button. Next, you'll want to watch my breakdown of why the traditional 60-40 portfolio is failing investors in 2026. It's exactly the next piece of this puzzle.